Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Novartis' stock so we can determine if it's a buy or a sell. Novartis is a large pharmaceutical company. Their biggest drug is Cosentyx. That drug treats multiple symptoms of psoriatic arthritis. In March 1996, the companies Ciba Geigy and Sandoz merged to form Novartis. At the time, it was considered the largest corporate merger. The company is headquartered in Basel, Switzerland, and was founded in 1996. Let's get started with the model. This is a large cap company, 219 billion market cap. They're trading at 103 a share, and they have 2.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they're definitely consistent. Their free cash flow is pretty steady. It was 11.4 billion in 2019, 11.6 billion in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was really high in 2021, 24 billion. But most other years it's around 7 or 8 billion. Revenue is the sales for the company, and that's also really steady. It was highest in 2021 at 53 billion, down to 52 billion in 2022. They did release their first quarter financials, and their revenue is 13 billion compared to 12.5 billion in the first quarter of 2022. Operating income is really steady also, almost exactly the same as last year. Same thing with net income. I mean, this company is steady like a rock. It seems like their numbers are so consistent. EPS is up a little from $1 to $1.09, but free cash flow is up a ton. It pretty much doubled from 1.4 billion to 2.7 billion. Let's look at the capital structure. 59 billion of equity, 28 billion of debt. They're 68% equity, 32% debt. Their net debt is 9 billion. So that means they have about 18.9 billion of cash on their balance sheet. I gave them a WACC of 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 290 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $264 billion. We divide that by 2.1 billion shares. And we get a calculated stock price of 124. They're trading at 103, so they're trading at a 17% discount. It's a buy according to the model. Simply Wall Street's at 163. They're saying they're 37% undervalued. Two analysts priced this stock. One is at 117, the other's at 120. This is where the stock has been trading since 2002. If you bought this stock in 2002, you could have got it in the low 30s. It ran up past 50 in 2007, then it came back down during the Great Recession. It got down to about $31 at its low. And then over the next 5 years, the stock price tripled. It broke through $90 in 2015. Then it fell below 60 in 2017, and it never got that low again. It almost hit 100 right before COVID, then fell to about 73, 74. But now it's trading at its all-time high, above $100. They pay an annual dividend, and they've been raising it a lot year after year. They're up to a yield of 3.36%, which is 64% of their free cash flow, 106% of their net income. There are 15 companies in the same industry as Novartis, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $1 billion in CapEx, which is a little higher than the median. They have a really good debt to equity ratio, one of the best ones on this list. For every dollar of equity, they have 50 cents of debt. The average is every dollar of equity is $1.80 of debt. They pay a good dividend, it's at the median. They generate lots of free cash flow, $11.5 billion. They rank 6th in market cap, a little bit behind AstraZeneca. They have a really good price to book. Their PE and price to free cash flow are a bit worse than the average, but their price of sales is better than the median and average. Their revenue is higher than the median and average, but they're not really growing too much. Just like Johnson & Johnson, they're at 4%. The 5-year annual revenue growth rate is 6%. That's the median. The average is 8% in this industry. So to summarize, they've been around 17 years. They generate a healthy amount of free cash flow. They have solid revenue, although their numbers are pretty steady. They're not growing. But they do pay a nice dividend. So for a long-term hold, it seems fine. I have them trading at a 17% discount. I rank their free cash flows, revenue, and ratio 6 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to become a member, you can click on the link in the description below. Thanks for watching.